sessions throughout this morning up until this afternoon. We've covered what are the right funding mechanisms to fund the climate tech transition, what's the role of blended finance. We've covered the value of death, how can we bridge the funding gap. And now this session's all about how can we scale up at speed, which is going to be moderated brilliantly by Jim Totty, who's the managing director at Viridis Capital and also a judge on our climate program. And there's been a nice kind of theme actually throughout the speakers today who are involved in our programs, which is great. But Jim, I'll hand it straight over to you to host the panel. So all over to you.
Great. Well, thanks very much. So welcome everyone. We've heard in the last panel a great discussion about early stage investing, and on this panel, as Sammy says, we're going to talk about accelerating progress along the whole funding food chain. So this panel is about the need for speed. And if first of a kind was impossible, well, we'd all still be living in caves, and we've seen solar and wind successfully access the large capital markets over the last couple of decades, with sectors like storage and EV charging following quickly today. And yet there's a need for so much more in a small number of years. And other technologies and other sectors have not found things so easy. Now our panelists today span the capital markets ecosystem from government and venture capital right through to large equity capital markets. I'm going to ask the panelists briefly to introduce themselves. We're going to have an initial discussion about the theme of speed in scaling, in sustainability. And then I'm going to take some audience questions. I want this to be interactive. I believe you've got Slido set up. So please send your questions in. We're looking for a really interactive discussion. But I'm going to start off at this end with a round of intros. Michael.
Thanks, Jim. It's a pleasure to be here in London. I'm joining you from Silicon Valley, and so a bit of a flight, but wonderful to meet some of my UK friends. Emerson Collective is a family office in Silicon Valley. We've got a lot of different tools in the tool chest, including philanthropy, policy, and I am on the venture capital team. I lead all our energy and environment investments. Typically, we invest in deep tech or software enablement around decarbonizing the energy system or electrifying transportation. I come at this from about 20 years in the energy technology ecosystem, having spent time both on the project finance side at Hannon Armstrong, as well as at the U.S. Department of Energy, where I was on the team that helped start the Advanced Research Projects Agency for Energy, amongst other things.
Hi, Tyler Christie. I'm Managing Director at Decarbonization Partners. We're a $1.4 billion global fund set up as a joint venture between BlackRock and Temasek. We invest at Series B to D in technology companies across the decarbonization landscape. We just closed the fund, but we've have now to date 7 portfolio companies with $330 million committed, and we see opportunity to be accelerating deployment, and it's a really exciting time in the market.
Hi, I'm Sarah Tennison. I'm the head of Clean Growth Strategy and Impact at Innovate UK. And I presume people know about Innovate UK, but we are, I suppose, the biggest climate tech funder in the UK. Last year we put in £720 million of funding into at least 1,700 businesses. So we support a significant amount of businesses to develop their solutions. Predominantly, we support, I suppose, businesses at the slightly earlier stage, but we do also support them in their scaling journey. We provide funding, but then we also provide that wraparound support as well. So really great business support, access to networks, access to investors, a whole range of kind of support that we provide.
Afternoon, everyone. Adrian Peacock, Managing Director at the UK Infrastructure Bank, which is a relatively new government-owned bank with a focus on accelerating decarbonisation in the UK and also regional and local economic growth. So we'll touch on some of the themes, but we're typically a later stage investor. We've been capitalised with 22 billion with the focus of getting net zero going in the UK, and we've got a number of products we can deploy to help that, from debt, equity, guarantees, and everything in between. So looking forward to a great discussion.
Great, thanks Adrian. So I'm going to start at the early stage, the start of the journey, if you like, with Michael. Startups often struggle to focus on what their capital stack should look like and how it should evolve, and what funding they need at later stages on their capital markets journey. So how do they fix this quickly? What do they need to do to help this issue?
I always love the tagline that progress proceeds at the speed of trust. And as you're moving along the capital continuum, the investors are looking for different things. So you might remember the book that was written about 15 years ago, Who Moved My Cheese? I find a lot of founders struggle because they were successful at one phase, but then the next one they're like, the game's changed, what happened? So I think it's important to understand what investors are looking for as you move forward. At the very early stage, when you're just getting started, most investors are looking for fire in the belly and what is your background, your earned secret. There's not a lot else they can look at that time because it's an idea. Then as you start moving down the scale to Series A, they want to see what kind of a team have you been able to recruit around this effort? How much progress have you been able to make on your technical plan? What did you do with that seed funding? When you move into the Series B, they're going to start looking at what is your go-to-market plan. It was one thing in the early stages to say it's a really big opportunity. It's another thing to say, now I am going to show you how I'm going to access it and who I'm going to start with. And this is where I find a lot of climate tech and companies get a little lost in the giant macro mission of saving the planet and forget that you have to solve a customer's problem. You have to start with finding someone who's willing to pay you for that solution, and defining your beachhead market and showing you can make progress there is really important to raising your Series B. When you move into Series C, you need to start showing you can deliver on that market. And so you're going to need to show where you're going to manufacture. Maybe you got a few of your first projects in the market. So, and then start talking to further downstream investors. You're getting out of just the equity stack into debt. Which it can be a little bit like putting your head on sideways, going from equity to debt. Because there's things that I want to hear and I care about as an equity investor, they're going to freak debt out. And so you got to make sure you're using the right words, the right glossary, and not accidentally stubbing your toe or shooting yourself in the foot as you move down the capital stack.
That's great. That's a really good summary. Sarah, I'm going to turn to you because the VC is not the only need at the early stage, and often government help is needed. Innovate UK doing great things in the UK, and we've seen other programs like the UK Green Investment Bank doing amazing things in areas like offshore wind going back a few years. Where is the government help needed most, do you think, in this sector?
I think it might be a bit controversial actually, because I think obviously we do put our money into the early stage, but I actually think really government help at the Series B stage actually is probably where it's at. I think at the moment you kind of assume that you need lots and lots of kind of companies, and there are lots of really interesting investors at the early stage who are willing to kind of take that investment risk, but I find that actually at the moment the Series B stage, where there is still quite a significant amount of risk when it comes to climate tech, there still really isn't necessarily the clear revenue models, the clear policy frameworks, the standards, etc. in place, yet the companies at that stage are still requiring significant ticket sizes. So for me, actually, more government help in the Series B stage rather than necessarily the early stage, where I think actually there's quite a lot of private investment coming in, is where I would stick the money.
And should that help be in the form of equity or grants or providing off-takes? How should that help manifest itself?
So I think there's something really interesting about building a ecosystem of lead Series B investors. So I think there is something about supporting fund managers to build track record, to build capability in climate tech, which can be de-risked with public money. So I think something like a blended finance, concessionary finance kind of model, which is putting money into funds to build the capability of funds then to invest in the Series B gap, is where I think that interesting public money could go into, rather than necessarily just kind of putting grant into businesses. I think we're always kind of worried that the businesses that we support really need to go on and get private investment if they're going to scale, because private investment and equity investment brings with it a whole load of skill sets into that business that grant funding just doesn't do. I mean, if you think about it, an equity investor helps that business access networks and customers, etc., that actually we just can't provide to the same level of intensity that an equity investor can do. So building that market for me is something where I think we should probably put our cash.
Good. Tyler, I'm going to turn to you now, and I guess you have the later stage perspective with larger tickets. Do you see real growth capital investments being made in this sector now to fund developers and new technologies and those kind of first-of-a-kind development platforms? Do you see that happening now?
Yeah, certainly. I think that it is a patchy market, to say the least. But I think there's some really outstanding companies. I won't just talk about our own portfolio companies, but I think there is capital being raised. I think when you look at the dynamics on some of those really successful companies, obviously the typical things that you would look for in most startups of an outstanding leadership team, great early stage investors, innovative technology that's competitive, right? Those are things that you kind of now take for granted when you look at companies. But interestingly, it's actually the financing mix of the companies as well, and the engagement with customers. One of the things we talk about and Decarb Partners under every single company we look at is we call the desperate customer. Where is the desperate customer for this company, and why are they engaging with the company in a unique way to get that product? So when you look at companies that have raised significant capital in Europe, like Northvolt, clearly there's a desperate customer that has engaged so much that they've actually, financed the company to scale. And H2 Green Steel is another example, earlier stage in terms of getting deployment, and there's other examples. But also there needs to be the policy clarity for those companies at least to get to that scale. And when we look at, say, an area like long duration storage in the UK, that's been problematic because the customer, unless it's just completely behind the meter, has had difficulty with understanding grid policy. And so the technology is there, the great teams and the customers want it, but we also need some policy certainty in those areas. So I do think there's capital flowing into these companies. It's not all up and to the right for every company, and there are different needs and use cases, but often what we see as the equation that works is when there's that customer that's really committed and there's a clear policy framework for the scaling on top of the usual things that we would look for. Hope that makes sense.
So give me an example of long duration storage, things you might be doing in the next 2 or 3 years.
Well, we've looked at this space quite actively over the last year, kind of banging our head against the wall. And there's fantastic companies out there with proven technology. It's not actually many cases a technology challenge. Some of it is a scaling issue when you look at companies like in iron flow space where there's still some innovation to get to the right duration level. But I think what we're more still monitoring in that space is actually how they're going to get paid and how the risk reward works out. So often right now the business model appears to be really almost like merchant risk. So you're going to bid a lot of CapEx in, and then you're not sure exactly how you're going to get compensated or when. Now, maybe for somebody with a different cost of capital or public backing that can cushion some of that risk, it can make something work. But for a pure equity investor, it's quite a risky proposition. So I think in that case, we know that it's needed. We know the technology is there. We've seen great teams, outstanding leadership in these teams. So I think it is coming, and it's evolving in different places. When you look in California or Texas or other jurisdictions that are evolving in different ways. So we see that as a pretty dynamic space. But the policy framework is really, I think, a key part of unlocking that.
And merchant risk is always really scary. Adrian, I'm going to turn to you in a second, but I do want to take some questions from the audience in a minute. So if you've got any questions, please put them into Slido. If you want to protest, please put that into Slido as well. Adrian, to enable realization of 2030 net zero goals, the investment needs clearly are huge. So how can businesses work better with institutions like the UK Infrastructure Bank to unlock investment capability? What role does UKIB play to unlock investment?
Sure, thanks Jim. Well, I think the reason the UKIB was set up was fundamentally kind of to answer that question, which is how do we accelerate net zero advancement in the UK? As a consequence of that, we also want to see regional and local economic growth. So most of our investments that we make actually tick both boxes. They're decarbonisation focused, but they're away from London and the southeast. So we're spreading that investment across the UK. I just want to take a step back because I don't know, we're a relatively young organisation, so I want to make sure people understand where we fit within the financing ecosystem. So we're 100% owned by the Treasury, but we're an arm's length body. So we've got our own board, we're separate offices, we're headquartered in Leeds. We have John Flint as our CEO, former CEO of HSBC, we've got a good mixture of kind of public sector backgrounds and private investor backgrounds like myself. I spent 25 years in infrastructure investment and 8 years now working for a government-owned bank, and it's different, but it's a different skill set, but it's a really good mix of people we've brought together there. There are 2 overarching missions that I've touched on, but 5 priority sectors, so energy, transport, digital, water and waste. We've got the full kind of toolkit to address those, and when I say address those, I mean we're looking for problems in the financing system that we can help unblock. So we want to crowd in capital using the halo effect that a UK government investor will bring, but importantly we can't be crowding out capital. So if there's a commercial investor that's interested in a proposition, we need to step away, and indeed in some cases we have done that. So in terms of scale, we have a 25 million minimum ticket size, so we do invest sometimes alongside later stage VCs, but we're typically, I guess, more Series C, Series D as an investor. We can't have a majority stake, so by definition these are pretty well developed businesses that are 50 million plus in terms of size by the time we can invest our equity into those businesses. And we have moved from a strategy of allocating to external funds to get some impact off the ground early in some of the niche sectors, and we're now focused on a direct equity investment strategy. We've got a real range of things that we can invest in, so just to give a quick snapshot, Cornish Lithium was our first direct equity investment in the southwest of England. Zero Avia, so hydrogen powertrain, zero emission aircraft. We've done pragmatic semiconductors, so trying to kind of kickstart and grow manufacturing of semiconductors in the UK, which is strategically very important. And the most recent investment we made directly was GeoPura, which is a mobile hydrogen generator business, so replacing dirty diesel generators. So, you know, I think for us as a young bank, we're just less than 3 years old. Getting our message out there as to where we fit into the ecosystem is really important. So, you know, it's obviously much later than UKRI and Innovate UK. And we tend to be Series C, Series D, and we've got, not represented here, but British Business Bank kind of in the middle as we see them, that are providing that. Often Series B, we've seen them invest in projects that we go into later. They have 70 plus, I think, funds that they allocate capital to try and stimulate that part of the market and that part of the scale up. But for us, we're kind of the scale-up capital, the growth capital that comes later on with the VCs, and you know, we're all ears in terms of opportunities for things that fit with mandate that are going to help UK towards net zero in 2030 and beyond.
Great, thanks Adrian, and you'll be glad to know you've got the first question from the audience. And the question is, how do you manage the need to deliver commercial returns within 5 years versus a need for patient capital as well? And does that reduce your potential for impact?
It depends on the product. I mean, we're here really to talk about equity. You know, with debt, there are other things you can do in terms of taking a longer tenor on the debt and pushing your risk further out, which is helpful. But given the context of today and the equity focus, it's challenging. We are patient capital. We often find ourselves investing alongside patient capital. It's not always a 5-year time horizon. But I think, you know, 2030 is not far away. It's a pretty short-term goal. We do want to see results. Economically, we should see results. We're here to make a profit as an organisation. But yeah, 5 years is it doesn't sound like a long time, but you know, we're in a hurry in terms of what we're trying to do. So we do want to see results within 5 years, and we're not necessarily looking for an exit at that point. You know, if there's still a relevant role for us to play, then you know, we will stick with the company if we think there's a role there for us. But yeah, 5 years is aligned in many ways with when we want to see change.
Okay. Now the next question we've had from the audience, I'm going to ask Sarah, and this question is do we have the supply chain in the UK, specifically engineering, procurement and construction, in order to be able to scale first-of-a-kind plants?
That's a very good question. I think probably not. I think we do have some really good actually EPC providers actually, and there's a lot of EPC providers I think in the UK which are servicing international projects that we don't necessarily know about that are happening in the UK. So I think actually we do need to develop the supply chain. It's going to be a real challenge for us to meet not only our decarbonisation goals, but for me, the UK content part of those decarbonisation goals, for me, if we get to net zero, that's really great, but there's a real risk that we're just going to import all of the tech. And for Innovate UK, who is supporting all of the tech, actually that's a real kind of risk. So we do absolutely need to develop them. I do think, though, that the supply chain need to be able to see really strong market signals for them to actually invest in this. And I think this is starting to happen. You know, we are starting to see some interesting projects actually being delivered on the ground. But I think that they do need to have some sort of comfort that the projects are going to be there, that they should develop in their supply chain, that you know, that this is a market that they should be going after. But it's probably not good enough. But I think we do have some good ones out there. Servicing really great projects across the world.
Great. So the next question that's come in, I'm going to ask Michael. I think this is a follow-up on your discussion on how things change as you move along the funding food chain, how you press the investors' buttons. And this question is, what advice would you give startups who will need a 10 million plus round within the next 2 years? What will they need to raise this?
So first of all is don't wait 2 years before you get started. One of the things that investors in my seat look for is knowing a team over time and seeing how they've delivered. So know who your target investors are and talk to them outside of a funding round. Update them on your business, get them familiar with who you are, what your vision is, the team that you've built, and show them where you're going. And then check back in with them 6 months later, a year later, and show them what you've done and that you've delivered on your promises and you've moved forward. I also think it depends on what stage you're going to be going for. Obviously, you need to be moving forward on your technical program and showing the milestone accomplishment. The other side, though, is you got to warm the market up to what your new solution is. Often, you're going to be selling into a market that's unfamiliar with what your product offers, and it's going to take a while to warm up those customers to be willing to pay. So I generally advise our companies to be out there talking to customers early. Sometimes it's CEO-led sales, because the CEO can often get an audience that someone who's a chief revenue officer or VP of sales isn't able to get. So that you know what are the pain points for those customers and what's going to get them to yes. And so you can bring that back to your engineering team and making sure you're designing the right product for them. I would also say it's important to figure out your narrative. We just hosted an event at SF Climate Week last week. Part of our superpower, we own the Atlantic, as well as some Hollywood properties, is helping people tell their stories. Often technical founders think this is kind of like the silly, squishy stuff, but it's really important to figure out how to communicate succinctly what you're doing and why your audience should care. And you're going to be talking to different audiences. Policymakers care about something different than investors, that care about something different than customers. And so working with people who are very talented communicators to really nail your narrative, being able to tell your story, is one of the superpowers that we look for in our companies.
Great, fantastic. Now, Sarah, there's another question for you here, I think following up on your comment about different kinds of capital being pulled together. And this question is which sectors do you see the biggest opportunities for blended finance?
Oh, you know, that's really hard, actually. I think hard tech generally, so I don't see it in software. I don't see it where there's a kind of clear route to market, so things like solar, offshore wind, kind of there. I see it in hard tech, hardware sectors, but actually generally across the piece. I suppose if you look at where kind of capital is going at the moment, it's very much going into mobility. And I think there are a whole load of other sectors which are not in that space where the money's not necessarily flowing at the moment. But for me, oh God, it's just a really hard question, because it's not like an obvious, it needs to go here or it just needs to go there. It just needs to go to a whole range of things. And that's maybe part of the challenge, actually, around kind of climate tech, is that getting your head around all of that is a real challenge for investment teams, and understanding all of those range of markets across a whole range of different, technological solutions is flipping hard to be able to kind of navigate it. So that's maybe part of the challenge as well. I think that's a bit of it's a bit of a cop-out answer. Does
blended finance help where you've got sectors where the value chain's not fully established yet, where the 15-year supply contracts and 15-year offtake contracts and full EPC wraps is not yet there? Does it help in those circumstances?
I think it does help in those circumstances. I think you need to be clear that there's still going to be some commercial traction, though, within the period of time that you would normally invest in. So So it can't be too far away from the market, I don't think, in terms of really where that money needs to go, because clearly there needs to be a pipeline of investable solutions, which I think is another question about whether we're seeing sufficient pipeline. But I think there does need to be a pipeline. I do think there needs to be some sort of market site that in the next sort of 5 years there's going to be some commercial traction, even if that's not necessarily developed. And I guess quite a lot of the markets at the moment are really being led by kind of government policy, you know, the CFDs, the hydrogen allocation rounds, the CCSUS competitions, et cetera, and the targets. And I think that brings in a market site, but an extra complication as well in terms of that growth. So yeah, I think I see it across the board, areas where there is going to still be some commercial traction, that you're not too far away from it, but it's still quite risky.
Mm-hmm.
Yeah.
Great. Now I've got one for Tyler now, thinking about larger ticket investments, businesses, plants and projects. How important is it to you in your business to track and report embedded carbon that goes into building bigger plants and projects?
It is quite important. So we do this analysis for every potential investment, and we track it on a quarterly basis, though really the numbers don't move on quarterly, but we do track this on companies that we're invested in. So it's an important element. I mean, in the scheme of things, really where we're investing, companies are typically scaling up to the first commercial facility. So while we do track this and do find it's very important in the scheme of the broader carbon emissions footprint of their industry, it's quite small. Mm-hmm. But what we do want is to make sure that they're on the trend to becoming as efficient as possible and establishing the design principles to do that as they scale up to plant 2, 3, 4 once they're able to access infrastructure funding for those stages. So, mm-hmm. So we focus on that, and we very much focus on the embodied carbon of the output product. So a company like Monolith in our portfolio that's producing carbon black, that's something where we do the carbon analysis of that, and it's very competitive compared to the incumbent material, and that's a part of our investment thesis.
Mm-hmm. Yeah. I'm going to ask a further question for you, Tyler. Obviously, working for organisations of the scale of BlackRock and Temasek, you've got the ability to move markets in a way that smaller investors probably don't. So when it comes to market demand, when it comes to first offtake agreements, long-term contracts, kind of first mover coalition type things, are you able to go into your wider investment ecosystem, your LP ecosystem, to help do that for your portfolio companies?
Well, we're early on our stage, just closed the fund, announced it last Thursday. I think we're underway in this in a couple of ways. I don't want to talk a big game before we deliver, but in a couple of companies, certainly when we invested in Group 14, which is a silicon anode material, we co-invested with Porsche. BlackRock has an incredible relationship with Porsche through capital markets. There's a tight-knit kind of relationship at the executive level that was helpful, you could say. Now, would they have done that investment without us? Probably. They need it. It's a desperate customer. But I think this kind of reinforces it that now we're partners both in terms of the commercial side and the capital scaling to help that business be successful. So I do think, we think about our name, Decarbonization Partners, as being well structured. So we partner with these corporate entities. Now, can we move markets? I wouldn't say that. But I do think as these companies, achieve these key milestones and engage these customers in more meaningful ways that are, frankly, pioneering for their industry, then that's what you see the following in those industries. And I think that's how we accelerate, is when more start following those success stories, if you will.
Okay, that's great. So I want to move the discussion back a bit towards the earlier stage now, but actually to do that movement back, I'm going to go back to Adrian. Because UKIB, you talked a little bit about the stages you invest at. Give us some examples with the newer technologies that you're investing in that might be kind of at the earliest that you will go. Just give us a feel for some of those.
Yeah, sure. So we will invest in first of a kind, but not untested, kind of unvalidated technology. So we will invest at the later end of the technology readiness level scale, which people are probably familiar with, but it goes from 1 to 9. We're at the 7, 8, 9 is the sweet spot, maybe TRL 6 is something we'll invest in. I mean, semiconductors, pragmatic semiconductors is a good example, a good live example, which we invested £60 million in December last year. That is, it's discussing pretty big offtakes, but it's not yet kind of fully revenue EBITDA positive. But it's a business that we got to know very well, and very proud to be backing in terms of what it's trying to do. So we're not afraid to kind of help support growth into new markets where it's on mandate for us, but we don't get involved in kind of the validation and early kind of TRL scale level. But I think, given the size of the challenge that we all face before 2030, we all need to take a bit of risk. First of a kind is what we all need to kind of lean into in order to solve some of the challenges. And I'm sure lots of key contributors, haven't even been discovered yet in terms of how we tackle decarbonisation. So whilst my career has been in finance, one of the fascinating things about my job is in the last 2 weeks I've had discussions around different uses for graphene and indeed different ways to make graphene, solvents for CCUS, space solar was this week as well, a bit early for us. Right. But fascinating stuff and just really reflecting kind of the minds that are being put to work to grapple with the challenge that we're all facing. So I think I've set out our parameters in terms of ticket size and TRL. So we're not kind of the earliest stage, but we hope to be pretty soon in the door after the VCs to kind of bring those to the next level and grow them in the way they need to.
So would we be right to think, compared, say, to the Green Investment Bank 10 years ago, you're definitely investing at an earlier stage to where they were?
Definitely, yes. The Green Investment Bank even invests in operating wind farms, for instance. So that was very much a kind of offshore wind. It did well for the sector. Mm-hmm. It was very focused on that. Waste as well. We've got a much broader remit. We've got specialists across over a dozen sectors, just directors on the team who are just focused on carbon capture, just hydrogen, just supply chain, just transport. We're really kind of got a broad remit. We're trying to go deep with individual expertise within that remit, but it's much wider than the Green Investment Bank was looking at.
Great. Let's come back to some practical advice, if you like. I'm going to come back to Michael. So if you're a startup, you're a small team, limited resources, how important is it to hire a chair or a CFO who really knows the capital markets and can help you draw that map of the future funding?
I would caution people to hire that role too early, because typically the really talented folks who have a network are going to want to be able to use that network pretty quickly. And so if you hire them too early, you're not going to hire the right person, and then you're going to have a difficult conversation to figure out how to replace them. So early on, I would suggest working with your investors and working with an advisor network, and quite a bit of just burning shoe leather on the part of the founder to get out there. Typically, a VP of finance is going to be enough for an early stage company that can help this. The CEO needs to really focus on what you can uniquely do. Keeping the books, FP&A, not something the CEO needs to be spending a lot of time on. So a VP of finance can be a great leverage point, but you don't probably need to level up to a CFO. In terms of a chair, it really depends on your network and what you think that chairman can bring to the table. Often chairmen are more in name only and don't really help that much. So I would be very cautious to hire someone and pay them very much if you don't feel like you're going to get a return on that effort. Just paying for brand value for someone that's high profile, I don't see work very often for an early stage company, because most investors can kind of see through it and realize that there's not a lot of marginal value in that.
Okay, that's great.
Sorry to my high profile friends who make money that way.
And you touched on external financial advisors. How important is preparing the company properly ahead of a funding round, and should you hire external advice to do that?
I don't know if you need to hire someone as much as it is having a network of friends who can give you some candid feedback on what you're going to be talking to investors about. Sometimes the advisors kind of get stuck in their own little lane and don't have much peripheral vision, but talking to friends who have recently raised a round and just saying, hey, I want to give you a dry pitch. Can you give me some feedback and speak really candidly to me? I did this recently for a friend, and her advice was, can you just not be on mute and just say whatever comes to your mind as I'm talking, so that she could get some real-time feedback. on what she was talking about. So I don't know if you need to hire an external advisor at the really early stage as much as it is making sure that you've got a network that allows you to have some practice pitches before you're really in the game.
Great. Now we've had some more great questions in from the audience. I'm going to throw one at Tyler now, which I think you'll be able to speak well to this. It's how much are financiers collaborating to scale solutions, and what more can funding institutions do as a sector to accelerate scaling?
Well, there's a lot of competition too. So we collaborate and compete, on deals and ability to invest in companies. But in many times, if you look at the cap table of companies we're invested in, there's many more investors on there. So often we like to co-lead investments and bring in strategic investors as well. So I think there's a real need for that type of collaboration, across the equity part. Certainly as well in other forms of finance, we'd love to partner more with UKIB. I think it's at a great stage, and we looked at some opportunities where we could do that, as well as in infrastructure funds and debt providers and others. So even for one of the companies that we recently invested in, most recent investment in Antora Energy, which is a thermal battery company in the United States, there's a project finance component, and so we very much collaborated with the other investors who are in the company, like Breakthrough Energy and Lower Carbon, to then help the company source the right partners for that project finance. And those are often people that we know, but it's figuring out how to tell the story, but then collaborate in a way that helps them be successful in that type of venture as well. Because that company's going to not just need to be successful in the first project, but 10 of them. Right? Mm-hmm. So very much, I think it's a I mentioned the competition because it'd be naive to say that there isn't, but I think in this space it's actually more collaboration than, say, when I've had experience investing in pure software space.
Got you. Great.
Just add one thing there. You mentioned strategic co-investors. I just wanted to kind of shout out to the importance of having a financial lead rather than a strategic lead. If you have a strategic leading your round, most of the financials are going to say they're getting something that I can't get. There's a reason they're doing this deal for strategic synergies. Maybe they're getting a right of first refusal or something that is of no value to me. And so they're going to have overpriced the deal for a financial investor. But if you've got a financial investor leading, and then you can bring in a co-lead as a strategic to kind of validate the technology, that's a much better deal dynamic and syndicate formation.
Great. We've got another question that's come in, which I'm going to throw to Sarah and then Michael. And this is about carbon and nature-based solutions, ecosystem services. And what needs to be done to attract private investors into this, what is a very nascent market?
That's a really interesting question, actually, because we have just closed a competition on nature-based financing, and we can fund about 4 to 6 companies. We've got 96 applications. So you say it's niched. I don't think it is niche. And I think it's actually all about the data. It feels to me that nature-based financing or financing nature-based solutions, the nature-based solutions, but it's really about being able to provide that data for the financiers who are buying the impacts from that, and doing that in a way which is trustworthy, validated, continuously monitored. And that's the approach that Innovate UK has taken, and it's where we've put our money in to support companies developing solutions like that, so they can then sell them to those solutions to banks and financiers who are looking for that data. But it's definitely not niche. I was really surprised.
Michael.
Sure. I just want to emphasize one of the words you used in there of trust. I mentioned earlier that progress proceeds at the pace of trust. And that's one of the big challenges that nature-based solutions have, is people have often sold some snake oil through that pathway. So my encouragement would be people who are in that field, be on the lookout for people who are bad actors, who are going to make the whole field look bad, and take them aside and say, play by the rules, do this right, be worthy of trust. There's an enormous opportunity in nature-based solutions, but there's a big trust problem. And I think everyone just needs to be eyes wide open on that issue and take it head on.
And how do you think the voluntary carbon markets rebuilds that trust?
So some deep introspection on what are the the mechanisms of verifying and validating those carbon markets are going to be important. I think having transparency so people can look through and understand the whole chain on the way down rather than just buying a piece of paper and not knowing what was behind it is going to be an important part of that. We typically don't invest in anything that I consider a long position in voluntary carbon markets. We invest in the intelligence layer. So we're trying to help people understand what is actually in these credits so that they can trust them. And in terms of rebuilding the trust, it's also knowing the media loves the hit piece, and you should expect it. It's coming. And so be ready for it and have an answer to the questions that they're going to be asking, trying to sling mud as soon as you get some progress.
That's great insights. I'm going to come to Adrian now, because this is a question about government funding, although not specifically you, it's about local authorities. So how can local authorities help attract investment into their towns and cities to help their businesses and residents reach net zero? And how are you interacting with those local authorities?
So we have a separate kind of local authorities team, which is a different part of the bank to where I sit in banking investments. But how do local authorities attract investment? It's no different to how it's been for a long time, I think. It's kind of having a clear plan and articulating that plan, and UKIB, along with the Public Works Loan Board, is part of the kind of financial infrastructure in the background that can provide the finance for a credible plan to help improve kind of local environments. Happy to, with whoever raised that question, I'm happy to put them in touch with the local authorities team and have a discussion if there's a particular point in mind. But it's something, 4 billion out of the 22 billion that I mentioned at the start is allocated and soft-circled for local authority lending. So for projects that are on mandate and are of interest to UKIB, there's very much the support there to help develop them.
Okay, so come and have a chat with Adrian afterwards about local authorities. Sarah, you've got a follow-up.
Yeah, we run a program which is specifically about developing local authority projects because it's a massive area of opportunity. It's also a massive area where there just isn't the pipeline coming through of investable propositions that can then be funded by the UKIB. The way that we've approached it is about developing capability within local authorities. So we are funding 54 local authorities across the UK, which sounds a lot, but it's still not that many really in terms of how many are out there, to build their capability to develop the investable projects. But there's also something I think about scaling those projects as well, because each individual project is actually quite small and it's not attractive to finance. So I think there's something about aggregating those opportunities. I also think there's something about some really innovative business models actually out there. There's things like, we've come across 3CI, which is a really interesting kind of model where you kind of put money into, I suppose, a FinCo, and then that puts money into development and operation of projects. It's not been tested yet. It's an idea. It's definitely not been funded. It's not an active thing, but those kinds of models, the way that Bristol City Leap is developing some interesting projects, so there's a whole load of opportunity out there. We're trying to develop the pipeline, but I think there's probably still a way to go before it can access actually the really great offer that is available from the UKIB for local authorities.
Great. Now I've got a question here which is for all four panelists, and it's a really important one about KPIs and impact measurement. So for each of you, and I'll start at Adrian's end, what KPIs do you use to measure the success of your investments in sustainability?
So we have a dedicated impact team that assesses prior to investment and obviously is involved post-investment and monitors these things as their day job and keep us honest in terms of what we're doing and the portfolio management team after we've invested. The key KPIs, greenhouse gas emissions, obviously, jobs created, extremely important. We think of the 3 billion we've invested so far, we've created either directly or indirectly about 8,700 jobs in the UK, so that's always a focus at Credit Committee. So greenhouse gases, jobs created, they're definitely two high-profile ones. And then the impact experts could give a much better answer on this, but we have the ESG and resilience framework as well, which is something that gets tested on every transaction that we make and is monitored. But it's a big focus for us. You know, we can't invest unless we've got a credible story, and we monitor to make sure that we follow up on that story and that we kind of deliver on what we've said we'd do at the outset.
Mm-hmm. Sarah?
So quite similar, I suppose. We really think about the economic impacts. We're really about business growth. We're about supporting businesses to access global market opportunities. So our metrics are very much around jobs, private investment, exports. I think over the last 5 years, our net zero programs have created 13,000 jobs, if I get that correct. And we've got about £5.4 billion of private investment. I'm taking it off the top of my head, I'm not sure it's right. The challenge, I suppose, that we have with impact is because we invest so early, we don't really know what's going to happen to that technology, particularly when we're talking about carbon emissions or greenhouse gas emissions, because we don't know how it's going to scale. We don't know necessarily what our counterfactual is going to be. So we're kind of wrestling with this challenge at the moment about how do we actually measure that? And it's quite a challenge to be able to do that, but yeah, economic metrics is kind of, I think, our primary focus.
Tyler?
I'd say ours is quite similar to UKIB in that regard. And like I mentioned, we do with every underwrite, there's a carbon analysis for the decarbonization potential of the product or service, as well as the company's own footprint. So that for us, being a decarbonization focused fund is clearly a high priority.
Mm-hmm.
I think we're somewhat similar, but being quite early, it's very hard to have precise measurements. And also the additionality thing is rife with double counting. So we do put a lot of thought into what is the size of the opportunity, what is the size of the decarbonization on the backside of unlocking a bottleneck with technology. But we don't over-rotate on trying to measure it with 15 decimal points out of the gate. One of the other things that I struggle with in impact reporting is the beauty of capitalism is there's price discovery. And so you can figure out really what does something cost, how do people value it. The challenge when you move into impacts is often there is no price discovery. And so how do you trade between different types of impact is just rife with the opportunity for false precision. So we try and be mindful of like what are the impacts we can really drive, and then where are we over-exercising ourselves and providing quantitative rigor. But we help a lot on the how do you like form your team to be equitable? How do you think about moving your impacts to maximize after we've made the investment? So we view it as we filter, and then it's a commercial deal, and then we really lean in with portfolio support to try and maximize impact on the backside.
Great. I've got one for Tyler here. How do you get your LPs comfortable with a relatively higher risk profile and longer term investment profile of clean tech versus more regular VC?
So we have 30 LPs. They're different shade. They have different interests. Some are really more bought in on the impact side than others, maybe more financially focused. So I think it's important to note that there's a diversity there. I think in terms of understanding the long-term commitment, I mean, and the vision there. I think there is some history. It's not as easy. You have to look for it, but there are some historical patterns of positive returns that we can look for. I think there's some negatives in the climate space that we can see, but there are in other spaces as well. So I think certainly helping them understand how some of that success patterns are then kind of integrated into how we're taking our approach, so we can use that as some historical basis that we know what we're doing, and much of our team has been doing this for 20 years. So that's certainly one part of it. But also when we look at these, I think at our stage of investing, we must go beyond that. The technology works. Right? The market needs to be there, and then the customer needs to be buying it. Obviously, and in our case, we're not taking much risk on negative margin businesses at this time. So this something we stayed away from that I think for other investors. I'm not knocking it, but high capex intensive businesses that are selling product at negative margin right now is a very tough place to be, and we've stayed away from all of that. And I think, to Michael's point, I think over the 2.5 years now we've been investing, we've built the trust in those LPs that have been with us, or the ones that joined us have been watching us a long time. So in a way, we're fundraising as well, just like entrepreneurs. So they're watching the longitudinal data. So sticking with that thesis, sticking with that discipline has built that trust. Time will tell, obviously. But as we've seen the companies now achieve the production milestones, demonstrating that the technology was significantly de-risked, that they could scale up, and then nailing these customer contracts to show that there is desperation for what they're doing, has been some at least solid validation for that to keep them interested. So that's multiple ways to answer that, but I think they certainly see that more near-term validation in the technology, but also we certainly work with them on where we see these markets going in the bigger landscape of the net zero transition, and why these markets will persist and these companies will be successful in the 2030s type of time frame as well.
And in terms of the term of investments, is a 10-year closed-end fund still right, or should it be longer closed-end or even open-ended?
I think it's good to have a diversity. I do think there's a really strong case to have funds that are more open-ended, like Breakthrough and others, and there's some industries that will need that. Right now, if I was, we're not really able to invest in fusion, frankly. It's a longer time frame. Somebody should be doing it. We would want to, different risk appetite, different structure of your fund. For us, we'd probably need to create a separate fund to do that, around that structure. So I think there's different use cases, but I do think one of the things that needs to happen in climate, and we're laser focused on, is returns. So I think there's going to need both durations, but really, if you want to come back to the topic of this, how are we going to accelerate, is that companies start returning capital to investors and going public and being really successful. And we've seen some of that, and I think it can continue. But we want to be focused on those getting returns going significantly in significant volume before 2030, rather than having funds that are have a duration towards the mid 2030. Thanks.
Michael, did you want to?
Yeah, I'd just say one thing to keep in mind if you're going for long duration is the market needs to be huge on the backside if you're going to need to wait for a while. We try and stay away from the patient capital label. We're not patient. We want to go fast, hence the name of the panel. But we are a long horizon. We are permanent capital, and so we can do fusion. But we do fusion because it's one of the few things that really could fundamentally change the nature of the energy market if we get it right. I mean, it's an enormous market. We're not going to do a long horizon deep tech project for something that's kind of a small niche product at the end. It really has to be a huge opportunity on the backside to justify the long horizon capital.
Great. So for our last 5 minutes, I want to just wrap up with a couple of questions about kind of the state of the market and how we see things evolving going forward. And Mike, I'm going to start with you. VCs are telling their portfolio companies at the moment, survive till 25. But we've got elections on both sides of the Atlantic. We've got an interest rate environment which is stubbornly not quite coming down as fast as we might all like. How do you see this year panning out for fundraising, and then how do you see next year and perhaps a couple of years thereafter?
There will definitely be a winnowing this year. There will be companies that raise money in 2021, 2022 at some kind of lofty valuations, to say it nicely, that will have difficulty raising again anywhere near that. And their investors as well as their founding teams are going to have to figure out, do we take our medicine and do a down round, or we just go do something else? There are a lot of funds out there that have a lot of dry powder. One of the challenges, though, in a down market is no one wants to catch the falling sword, is the way we talk about it. And so people want to see some amount of kind of like turnaround to know where the price environment has stabilized. We're starting to see signs of that. We did the Antora deal with our friends at Decarb Partners. So you're seeing lead checks get put out there for new priced rounds, which is promising. One of the other aspects, though, is a lot of the permanent capital is fully allocated at the moment. And so we need to start seeing some exits to recycle some of that capital. I was just talking to two similarly situated family offices over the past week, and they're both like, we can't do anything net new until we get some exits from the existing portfolio. So there is a bit of a logjam out there right now. Hopefully we'll start seeing either some strategic M&A activity, buying some of these companies, or the IPO window opening back up. They'll also listen things.
And will 2025 be better or more of the same?
There's a lot of people are hesitant in front of the election. And so I would suspect that 2024 is definitely going to be a put your head down, execute, do the usual commercial things to build a company. In 2025 will be a very different ballgame. Tyler,
what's your perspective on the future?
I think that's, I actually echo a lot of those comments. We sometimes think you're better lucky than smart. We started deploying in our fund in 2022. That was probably much better than starting in 2021, I would say. I think right now, I was investing in a different fund, in a different space in 2018, 2017. I think there is a need for those funds to find some liquidity, and the companies right now often aren't in a space where they're really able to attract full growth equity. So I think you'll see some repricing, liquidity, secondary market that really emerges in this regard, and I think there will be companies that will hit the wall and they will not succeed in that in this environment. So I think it's going to be a tough year, but at the same time, I do really think that there's fantastic companies out there. There's great investment opportunities, and there's definitely a flight to quality. I think there's certain pockets as well where you're seeing companies get pretty outlandish valuations that you would think of as 2020. We look at it and we're like, that's a 2021 deal, and then we think, well, maybe we should still do that because they actually all the things measure up. So I think there is those opportunities around, and there's some appetite for it now. Definitely more sober than 2021, but I think where there are great companies, I think and in great markets with solid customers, there is capital and there will be great valuations for those companies. So.
Okay, and then final question, which I'm going to ask for both Sarah and Adrian. We're going to go forward 5 years in time now. Get your big crystal ball out. What are the successful exits going to be? Which sectors at the end of this decade are we going to be saying have actually gone really well? And who will the buyers of those businesses be?
God, that's really hard. Specific sectors in the next 5 years. I think we might start to see some really interesting stuff happening on hydrogen, actually. Mm-hmm. I think with the hydrogen allocation rounds coming, I think that we're seeing buyers willing to take green premium in the offtakes as well. I think that's a really interesting trend that's happened over the last sort of 3 to 5 years, where strategics are now are willing to pay the price, or up to a point, potentially. Oh gosh, I don't know whether I can answer your question when it comes to sectors.
Chuck it to Adrian. Of all your stable, Adrian, which success are you going to be toasting in 2030? What are you most excited about?
I mean, I think that there are many that aren't yet in the stable that will be very relevant in 2030. And just taking carbon capture as an example, this is going to be a tremendously big year for carbon capture technology. Some big projects, some evolving new technologies, and use cases for those. So I think in 5 years' time that will look like a very different market. We'll have had multi-billion pounds invested in it, and some pretty impressive infrastructure on an industrial scale dealing with a massive problem. So that's one. I think we've barely got started. The government understandably has taken a long time to get the policy right and the RAB models and the CFD type structures, but that now that's in place, we are primed for a very busy year looking at opportunities in carbon capture. So that's one certainly I'd highlight.
Okay, so carbon capture is the sector to watch. Thank you very much, everyone. We've had a really interesting discussion, some great questions from the audience. I'm glad we've made it interactive. Please give your appreciation to our panel.